Hello and welcome back to Simple Money Podcast, Canada's own personal finance podcast, presented in short and informative episodes. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. So, like an old pair of pants, sometimes we just grow out of our financial institutions and just need something different. There are many different reasons why we may want to break up with our bank, but it really comes down to the simple detail that we're typically not happy and want something new. So, for today's episode, we'll look at some of the common reasons why people break up with their banks and then create a roadmap on how to ditch them for good. Thankfully, it's not that hard to switch over, and typically you'll be much better off afterwards. So, one of the first things that I always tell someone when they're thinking about switching financial institutions is that it's important to remember that your financial business is extremely valuable and you should do what's best for you. Dealing with financial institutions can often make you feel like you're just a number, but I assure you that this is not the case and that any financial institution that you deal with should really earn your business. So, there are many different reasons why individuals want to switch their banks, ranging from lack of customer service, high fees, poor performance, and just better products offered elsewhere. And one of the biggest concerns that are often brought up about financial services is the lack of suitable customer service and advice. This often germinates from banks pushing their products at the expenses of exploring what's really best for you. And in the financial world, this strategy is called the product first strategy. And this strategy has a tendency to create a conflict of interest because banks have incentives to maximize their profits off of your business, which can unfortunately be at the expense of giving you the best advice possible. And now we've spoken about this a lot in the past, but at the branch level, it's important to understand how they operate. Their bank representatives typically have very aggressive sales targets that they must meet. And the outcome of a bank rep hitting their sales targets is pretty important for the performance of their job. And this includes something as important as keeping their job, future career opportunities, and financial compensation. So the incentive to meet these targets is obviously important to the representative that you're talking to and strongly intertwined with all dealings at the branch. So this translates into a problem where a bank representative may often not fully explore your financial situation and needs. Instead, they will take the product first method of recommending certain types of solutions like a mutual fund or some kind of a lending product before they even fully know your situation. And over time, this structure unfortunately creates an erosion of trust that can often push clients away. And the feeling that banks are really not giving advice in individuals' best interest is typically the largest complaint that I hear when people are thinking about changing their financial institution. Now, another really common one is that the banks may not be there for them. A financial institution is managing your money, and they should be contacting you at least once or twice a year to review your current holdings, your financial situation, and just make sure that everything is on track. And it's imperative for a bank representative to check to see, if there are any large life changes that would affect your personal situation and so on, right? Because you need to adjust how your holdings are being held. And then the final big cause of bank divorce is about how much they charge in fees and how little they pay in returns. So bank fees are definitely expensive. And if someone has some type of an unlimited account, this will very often cost about $15 per month. And this translates to $180 a year. Then this is about $900 over 5 years, $1,800 over 10 years, and so on. And you can see that this money can be better used for other types of purposes, right? Possibly like putting money towards, your retirement or saving for a child's education, paying down debt, and so forth. And what we see is that bank fees are only part of the charges that are incurred. And the reason why these are most often brought up is because they're the most transparent and, easily seen. Another type of account that banks often offer to their clients and have fees that are not as transparent are mutual funds. And these types of investments typically have fees that are more expensive than other types of low-cost investments like exchange traded funds, and very often can cost 1 to 2% more in annual percentage fees. So, for example, in a $50,000 investment portfolio, that's an additional $500 to $1,000 a year that you're paying in fees just for holding those investments. And then on top of that, there can be other fees through overdraft, car loans, etc., etc. So you can see why banks are so profitable. And I'll be totally honest, if you're receiving suitable customer service from the financial institution for all the charges that you're paying, then it may make sense to stay there, right? If they're meeting with you on a regular basis, giving you very valuable financial guidance, then the amount that you're paying for the bank may actually have value. But if you're not, then it may be time to consider some other alternatives. And when we look at the actual interest rates that banks are paying, what we see is the returns are also very subpar. And there's a whole spectrum of other reasons why people may want to leave their bank, including having better banking services that meet their needs. Possibly they prefer in-person or digital meetings. Also, individuals will often leave banks if they feel like they've been mistreated. Also, what we're seeing is that more and more people are disagreeing with the ethical choices that financial institutions are making, and more. The good news is that if you're looking at breaking up with your financial institution, it's never been easier. Online and regional offerings offer access to services that have better customer service, lower fees, and higher interest rates. There are online checking accounts with no monthly fees, robo-advisors like Wealthsimple that offer investment management that have fees that can be as low as 1 to 2% less than the typical mutual fund fees, and online high interest savings accounts like EQ Bank that offer interest rates on savings that is currently sitting at 1.5%. Regional offerings like credit unions can also offer a banking experience that really trumps what you see in the large financial institutions. When you deal with these organizations, you are also a partial stakeholder in the credit union, and many offer ethical business models, such as having neutral environmental impacts. So, the first step with dumping your bank is really to decide what type of services you're looking for. So, some of the important questions that you will want to ask yourself include if you're happy using online options, how many transactions you expect to do, does the access to your banking services meet your needs, and more. And a solution that many people also do is they'll also just switch certain fragments of their total financial picture to better offerings. Like, for example, maybe you just want to shift your investments away from a large financial institution to a robo-advisor and keep everything else with your financial plan the same. And if you really are happy with your bank, you can also take one last shot at speaking to a representative in your bank and to see if they have any other options that will meet your needs. And the steps with doing transfers really depend on exactly what you're moving over. If you're transferring over a bank account, then you're going to need to make sure that you switch over your income and any pre-authorized transactions. And you'll also need to reissue any uncashed checks that you may have made, possibly for future rent dates or some other type of expense. And you'll also want to consider any infrequent transactions that come out of your account or go into your account, such as CRA deposits. Now, if you're looking at transferring over your investments, thankfully it's a little bit easier. What you do is you open up a investment account at whichever financial institution you decide to stay at, and essentially they will fill out the transfer forms over there. The only thing that you really need to watch out for are fees that will be charged from the transferring organization. Some types of mutual funds may have rear load fees that can be fairly costly. And typically, anytime you transfer over a registered account, you're probably going to pay about $150 to $200 to do that. And now, if you're transferring over a checking account, this is typically the most tricky thing to move over. What you would want to do is actually speak with a representative at the transferring organization, because very often they have certain types of programs that will help make things as easy as possible. Also, in many cases, if you are ever charged a non-sufficient fund charge when you are in the process of transferring, you may want to talk to the transferring organization, as very often they could actually reimburse you that amount. And when you're looking at transferring, you may also want to see what type of promotions are out in the wild. Very often what we see is that there are cash bonuses for transferring, and in some cases, there can be other types of promotions like giving you an iPad for doing the transfer. When you're looking at transferring over account, usually what's recommended is to keep your old account open for a month or two just to make sure that everything was done properly. And of course, you'd want to make sure that you just have some buffer of cash in that additional account to make sure that everything goes through properly. Once everything's been transferred over, then you can simply just close the account, and that's that. And just a word of caution for anyone that's thinking about transferring old credit cards. This is something that could actually have negative consequences if you have an old credit card, as canceling a card with an extended credit history can lead to a drop in the score. So if you have a founded credit card at an old financial institution, you may want to consider keeping that to keep your credit score as high as possible. So that is it for today's episode. As always, if you enjoyed the episode, please consider sharing with a friend or family, and also rating us on whichever podcast provider you're using. And if you have any questions for me, or if you want to suggest future episodes, you can send me an email at info@ffcoach.ca. So that's it for today. Talk to you soon.